Let me start recording. Okay, you guys are welcome to our meeting today. So, what we discussed the previous week, we talked about uh, we talked about resistance. We talked about support. We talked about we also talked about the trend of the market, the uptrend, the downtrend, the consolidation, right? And I believe we all now understand what a consolidation market is, uh, what an uptrend is, what a downtrend is, and you understand how the market moves. Because why I always emphasize on this is because if you understand this is the basic thing you need to understand as a trader. The uptrend, the uptrend, the uptrend, the downtrend, and the consolidation. So if you can be able to understand this thing and can be able to identify it in the market, in the charts, like this. Let me clear this. If you can be able to identify it in the charts, oh, this thing. I can't clear this one. Let me look for another one. Okay, now if you can be able to identify it in the chart, the uptrend, if you can identify it in the charts, the uptrend, the downtrend, and the consolidation. If you can identify these three things in the chart, you've understand how the market moves, right? If you can come here and check, if you can come here and identify now where is this market going, you have seen that this market on 4 hours, you have seen that this market is an uptrend. The only thing that comes to your mind, now this is an uptrend, what next am I going to be doing? When this market, you see that this market is an uptrend, what you ask yourself, what next am I going to be doing? What are you going to be doing is, where am I going to be buying from? Where am I going to be buying from? Right? Now you have seen that this market is an uptrend. What else are you going to be doing? Where am I going to be buying from? Where will this market get to? Then I will buy. When this market is a downtrend, when you see that is a downtrend, what are you looking at? You are looking at, where will I be selling this market? Where will this market get to? And I will sell. Do you guys understand? Where will I be selling this market? These are the only two things that we do in the forex market. It's just only two things that we do in the forex market. We buy and we sell. right? So once you come to your trading view, the first thing you have to check is the market structure. The first thing you have to check is the market structure. You have to first of all identify the market structure. Once you come in a chart, the first thing you need to identify is the what? The market structure. Are you guys taking note of this? What I'm saying? Once you come to the chart, the first thing, once you open your trading view, the first thing you need to check is the market structure. This market now, where is it going to? Is it going up or is it going down? Is it an uptrend or is it a downtrend? This is the first thing you need to consider. You need to check before you now analyze your trade. You now start to analyze. Understand? These are the things you need to check before you analyze. I gave us assignment last week. Bright. Yeah, I gave assignment last week. Is there any misunderstanding? Is there anything confusing to you in the chat? Because I you passed your assignment, right? I think you passed all your assignment. Huh? Let me check. I think I have it here. Okay. I You are the first person that submitted the assignment here. Okay. Okay, consolidation. This is the consolidation that I told you is not a consolidation because of how it looks, right? So now, you know the kind of trader you are. You have to understand the kind of trader you are. First of all, me personally, I'm a day trader, day intra-trader. Will I say intraday trader? Because sometimes I tend to leave trade for like 2 days, some 3 days. So I day trade. I'm a day trader. Do you guys understand? So when you start trading, you need to understand the kind of trader you are. We have three type of traders. Number one is the scalper trader. A scalper trader is a trader that enters the market and take advantage of the market within 20-30 seconds. That is a scalper. A scalper is someone that comes to the market, scalp the market and leave the market within 20 seconds. And a scalper analyzes the market from 15 minutes, 5 minutes, 3 minutes and 1 minute. The time frame that a scalper uses to analyze the market is 15 minutes, 5 minutes, 3 minutes and 1 minute. The lower time frames. A scalper analyzes the market with the lower time frame. Then a day trader is a trader that trades the market for the whole day. For the whole day. A day trader is a trader that analyzes the market from 4 hours, check the entry and take the trade from 15 minutes, 30 minutes, 45 minutes. That is a day trader. A day trader trade does not does not leave a trade till the next day. That's the simple definition. A day trader trade come to the trade for that day and leave the market. That is a day trader. Then a swing trader is a trader that live that trades 1 week, 2 weeks, 3 weeks and above. A swing trader is a trader that comes to the chart, analyze the chart from the monthly time frame, weekly time frame to the daily time frame and take his entry and wait for his entry within from 1 hour and 4 hours. That is a swing trader. A swing trader allows his trade to run for 2 days, 3 days, 4 days, 5 days, etc. A swing trader can allow his trade to run for almost 1 month, 2 months. That is the difference between a scalper, a day trader, and a swing trader, right? So when you start trading, you have to first of all identify the kind of trader you are. Identify the kind of trader you are. Oh, that's when you start trading. Identify the kind of trader you are. So that is it. So now, as US30 is concerned, most of the times we as US30 traders, we usually analyze the trade. We usually analyze the trade from the monthly time frame to see the clear view of the market. We always do a weekly top-down analysis of where the direction of the market. We start from the monthly, we take it to the weekly, from the weekly we take it to the daily, then from the daily we take it to 4 hours. 4 hours is our final bus stop when analyzing US30. Then if you decide that you want to day trade, you can analyze the market for 4 hours. Within the 4 hours, then you check your entry. Once the US30 open, you wait for your entry. Once the US30 open, you wait for your entry. Then you come to 5 minutes. You can take your trade within 5 minutes with 5 minutes entry, right? So if, let me give you an instance. Now, this is trading section. If you want to know the section that we trade, you come to this place. You see where the right indicator. You come here, you search for trading section. My own is already there. I start it. You can start it and check to know the trading section, especially when you want to backtest the market. You know the trading section. This is the trading section. Then you click on it. Once you click on this trading section, you will see the color, something like green color will appear. This is the section. This is the New York section. Only New York section. If you see, it's written here New York. Can you guys see? It's written New York. Average, where the market gets to, the range, right? So this is how you see. These are all the New York sections. The previous New York section. As you are going back, you'll be seeing the sections. So this is what the indicator does. So if you want to know what the New York section did the previous time, you just come to this indicator, type trading section and check. Like I said, we usually trade only New York section. We trade only New York section. So that's why I put New York session here. That's why I specify only New York session. When you open it, you can still see other sections like London section, Tokyo section, Asian section. So you can see them. But I just marked only New York session. I just want to be seen only New York session because that is the section I trade, right? So that is it. So now if you want to analyze your trade, you start from the monthly. And this is our entry confluences. We have 6 entry confluences. 6 1 2 3 4 5 6. We have 6 entry confluences, right? The first confluence we have, I talked about, I even added one more, which is the market structure. This is what determines if you can enter a trade or not, right? Without this 7 confluence, without seeing out of this 7 confluence, without seeing like 4 confluence, you can't enter a trade on US30. It's not advisable. That means you are gambling. If you don't see these 7 things, 7 confluences, you are not allowed to enter the trade. If you don't see 4 out of these 7, you are not allowed to enter that trade. So what are the entry confluences that we have before we enter US30 market? What are the 7 confluences? The 7 entry confluences that we have is market structure. We have the market structure, right? We have the market structure. Then number 2, we have the psychological level. I will explain this one after the other. What is market structure? Market structure is, let me list. After listing them, I will now explain each and every one of them. We have the market structure, right? We have the psychological level. Number 2. Number 3, we have the trend line. Number 4, we have the chart pattern. Stroke the candlestick formation. Number 5, we have the CNBC. Then number 6, we have the Fibonacci, right? We have the Fibonacci. You guys know what is Fibonacci. Then number 7, we have the key levels. Right? So now this confluences, is even here. These confluences, when you see 4 out of these confluences, right, you can enter the trade. When you see, maybe you see key levels, Fibonacci, CNBC, chart pattern, you can enter the trade. Out of these 7 confluences, if you see 4, you can enter that trade confidently, right? So now I will explain each and every one of them. Now, what is market structure? Now, if you want to analyze a trade, first of all, when you open your trading view, what do you check? You go to your monthly time frame, the monthly time frame here. What do? You first of all check where the market is heading to. Check where the market is heading to. As you guys can see, you can you believe me that this market is going up, is an uptrend. From looking at it from the monthly view, you you agree with me that this market is an uptrend looking at it in the monthly view, right? Then now, what else am I going to do when I see something like this? I have already identified the market structure. This, we have already done it. This one, we have already identified the market structure. We have already identified the market structure, right? We have already done this one, the market structure, by this. Then number two should be the key levels. Now, the second one is the key levels. The key levels. I want to wait. No, I want to each and every one of them. I just want to. Okay. So now, what do? You just have to. It's not. I want to highlight particular one, but anyways, let's leave it like that. So now, what do? We have done this one. We have done this one. The market structure, which is this one, which is this. Number two, the next thing we need to do is key levels. We'll mark out our key levels, right? Where is our key levels now? What do we do now to get our key levels? Now, to mark our key levels, we'll take our rectangular. This is the highest level that the market has gotten to. We'll mark it out. Now, this is the lowest place the market dropped to, the lowest from the monthly time frame, from the monthly. The lowest place that the market dropped before it now went up here. So now this is another place that the market rejected. The market rejected this place before it now break this structure. It's called break of structure. Before it now went up, it broke this structure before it now went up. This is another key zone. So we saw 3 key zones in a monthly. So what do? We'll move down to the weekly. We'll move down to the weekly, right? So now, in the weekly, we have seen that, okay, now we have identified the key zones. These are the key zones, right? So now I'm not seeing any other key zone. What else are we going to look out for? For now, I'm not seeing any other key zones for using the weekly time frame. So what else are we going to do? We'll now move down to the daily. To see a clear view, right? So now we'll come to the daily. Once we come to the daily, have you seen that we are seeing a clear view now? We are seeing a clear view now, right? So now, what do? I'm seeing a trend line here. Now, we have already identified our market structure, key levels. We're still going to identify some key levels here because we are still on the daily. So now, we'll bring our trend line. Now, we have gotten like 3 out of 4 out of our 4 confluences. So what do we do now? We'll now draw this trend line from here to this place. This is our trend line. Can you guys see? It touches, trend line have to touch like 2 or 3 candles before it is valid. It becomes valid. If it doesn't touch two or three candles, it is not valid. Like I said, it touches here, this third one, and it touches this second one and third one, right? So now we have already gotten our trend line, right? Then what else are we looking out for? We'll now check our psychological level. We'll now check our psychological level where the market reacted to. Another psychological level that I'm seeing here is 49,000. The market reacted at 49,000, which is this place. This is our psychological level. Our psychological level. Our psychological level is, which is 49,000. The market reacted at 49,000. Right? Then now, what are we going to do? We'll move down to the 4 hours. We'll move down to the 4 hours. Let me remove this. We'll move down to the 4 hours. If you don't understand, you ask question, please. If you don't understand, you still ask question, right? So now you guys see that the market, we have gotten our market structure, our psychological level, our trend line, our key levels. 1, 2, 3, 4. You see that we have already gotten like 4 out of 7 confluence. We have gotten like 4 out of 7 confluence. So what else are we going to look out for? We will now look out for our Fibonacci. We'll look out for Fibonacci, right? So we'll draw our Fibonacci. Let's bring out our Fibonacci. We'll draw our Fibonacci. This is the previous place that the market reacted to. We'll draw it from here. No. The market has been dancing from this angle. So we'll draw it from here. Can you guys see me? Can you see my system? Can you see the system? Okay, we'll now draw it from here to this level. We'll draw it to this level. So guys, you now see that the market is just reacting. We have gotten like 5 confluences. The market is just reacting at the 50 and 61%. Our 60 and 51% key Fibonacci level. Can you guys see? The market is reacting at 50 and 61% of our key Fibonacci level. Right? So now we have gotten 1 key levels, Fibonacci, psychological level, trend line, then market structure. So what is remaining for us now is chart pattern, candlestick formation, right? And CNBC. This CNBC is usually when the market opens. It's confirmed when the market is what? When the market is open. Understood? So now, once you see that you have gotten this, you look at the 61 and 50% where the market is heading to. The next place is the market is heading to. Seems now that there has been a reaction. The market has been consolidating from this angle. From this angle, this place, the market has been consolidating. It goes up here. From the 4 hours, it goes up, comes down, go up, come down, go up, come down. This is what the market has been doing. On the 4 hours, it just pull out down here, then went up again, come back here, went up again. You see that the market is consolidating here. It pushed up from here and come here and still went down again. So now what are we expecting? Since we have already gotten our 5 confluences. Now what do? We will now expect the CNBC to open. Once the CNBC open, we will now check the chart pattern. What are the chart patterns that we need to see before we enter the market? The chart patterns that we need to see before we enter the market. When you see an engulfing candle, engulfing candle, when you see the engulfing candle at the support level, you are good to enter. This is example. This is example of an engulfing candle. Let me use this one. This is the example of an engulfing candle. Can you see? Engulfing candle. This is the candle that we need to see to confirm that the market is about to pull up. When the market is at the bullish level, which is the support. Then when the market is bearish, this is the candle you need to see to confirm that the market is about to sell. These two engulfing candle, take note of it, at the bullish level, which is the support, and the bearish level, which is the resistance level. Understood? So when we see something like this at this range, we are good to enter the trade, then put our stop loss. But currently now, the market is just consolidating. We have not seen the current view of the market. Right? So another key level that I'm still seeing here, I'm seeing another key level at this level, this place. If the market does not break it, if the market does not break this level, that means the market is going to push up again. It's going to push up. So we can literally put our stop loss, allow the market to come this angle, which is the 100%. Then we'll put our stop loss here. Then we take it up again. It's likely to, if it can break this zone, it's likely to come to the 27% or 61%. Do you understand, Bright? Or is it confusing? Huh? Is it clear? The stop the, the stop loss, our stop loss, you can come here, mark out with this our with this, this tool. Remember I talked about this tool, the long position, right? I talked about it. Then you drag it to this level, let's say 27%. Or when it still comes here again, you can close your trade. This is about this is about this is your stop loss. Stop loss is the red. When you are seeing the red, then the green is the your profit when the market goes your way. So now it's about 1,300 pips. So let's say for instance that the market comes here, take us in, then push up to this level, right? It comes here, push up to this level. We are going to come back again because of it will soon expire. Our this thing will soon expire. So this is where you can confidently enter this market again. If it doesn't break this 100%, you can confidently enter this market. So this is how you analyze the market. Then couple with the CNBC. Once the CNBC is open, the market is open. Once the market is open,